Hello, everybody. Ed Yardeni here. It's May 19th. It's Monday, and maybe we'll have another interesting week. I'm sure it'll be interesting. Question is whether it'll be fun or not. Past few weeks have been a lot of fun ever since the correction in the S&P 500 bottomed on April 8th. Then we had on April 9th the postponement of Liberation Day for all countries except China. And then I think it was May 12th, just last week, on Monday, we got news that there's going to be a postponement, a combination of a reduction in tariffs and a postponement of some of the tariffs on China in their trade war between China and the United States. So it's been a heck of a lot of fun to the upside. It's been a V-shaped recovery. We did sort of anticipate it in our April 7th morning briefing. It was a Monday, and we suggested that the reaction, that piece was called Annihilation Days. And we pointed out that Liberation Day, which occurred on April 2nd at 4 p.m. in the Rose Garden after the market was closed, the reaction of the market to Liberation Day was Annihilation Days. We had Thursday and Friday, the markets took a huge dive. And so on April 7th, we wrote the morning briefing was titled Annihilation Days. And we said that we thought that sooner or later, the president would have to postpone the tariffs. And when he did postpone the tariffs, we might get a V-shaped recovery out of that. And again, that was April 7th. April 8th, we made the low. On April 9th, the market started its V-shaped recovery. So far, so good. We are now seeing more and more people asking whether we're getting close to making a new all-time record high in the S&P 500. Meanwhile, while everybody's still pretty excited on the equity side about the V-shaped recovery, on the bond side, there's a lot of nervousness. Triggered over the week, triggered on late Friday by Moody's, reducing the credit rating of the sovereign debt of the United States. No big surprise, really. I mean, they had kept their rating at the highest on their scale, while back in, I think it was the summer of 2011, we did in fact see that the S&P credit rating agency lowered the credit ratings of the United States by a notch. That had a pretty dramatic impact on the bond market. Bond yields soared on that. And then I think a few years ago, Fitch joined into the fun. And Moody's, for some reason, in the midst of all that's going on, decided that they wanted to downgrade the U.S. credit. No real surprise of why they did. Maybe just the timing issue is here we are in the midst of the White House and the Republican majority in Congress trying to cobble together some sort of budget deal. And who knows, maybe it's a budget deal that will actually be a credible one that will have the potential for reducing the deficit relative to GDP. Well, I am an optimist, but let's not exaggerate. I mean, it's a little hard to imagine that it's going to be something that clear cut. And maybe Moody's just figured out no matter what, it's still going to be fiscal excess coming out of Washington. Or else they decided they wanted to have an influence on what goes on in Washington and figured if they lower the credit rating, maybe that would push bond yields up and get the attention of the politicians that they need to get us in a sustainable path for fiscal policy. Bond market, I think, also was a little bit unnerved when Walmart, actually, yeah, I think it was Walmart, announced that they're going to be raising their prices to reflect the increase in tariffs, and the president basically put out a social media note saying that they better not, that they should eat it. And I don't think Walmart is going to do the president's biting. Maybe as much as they can, they'll do it. But there's just some cases where the tariffs are leading to such a prohibitively high increase in the price that if they're going to stock it, they're going to have to raise the price. So that presumably will be reflected in the next few months. We're likely to see higher price inflation. So we could get a kind of a meltdown scenario for the bond market, which would make it hard for the stock market to continue melting up. Let's talk a little bit more about the bond market. Uh, we do have the president struggling with his own party in Congress to cobble together a deal on the budget. There's a lot of debate about Medicaid and what kind of reforms can be passed on Medicaid to slow the rate of spending on that social welfare program. I don't think there's any talk about doing anything meaningful on Social Security or Medicare, so those are sacrosanct. But the Republicans feel that maybe there's some political give on the Medicaid side. But I think the question will be how this all gets scored once the Republicans come up with their plan. And if at the end of the day, the ultimate score may turn out to be the bond market. I've been fielding some calls from reporters today asking me whether the bond vigilantes are back. And I said, well, they're mounting up again. I don't know if they're exactly back. You know, the bond vigilantes are not the only players in this game in the credit markets. The Fed matters, and of course, so does the Treasury. And I think that one of the problems the bond vigilantes have in expressing their opinion, let's say they get the bond yield back up to 5%. How long is it going to stay there? It didn't stay there like a nanosecond. Oh, look at that. Max is awake all of a sudden. I'm glad that he moved, because sometimes he'll just stay like in a coma like that during the whole show. And so I get some calls wondering whether he's a real dog or a stuffed dog. Uh, well, he likes to eat a lot, so he is a stuffed dog, but he's alive and well, and he always likes to join us in all this. But look, the bond vigilantes, even if they got it up to 5%, it wouldn't necessarily stay there very long. This notion that we'll have an auction where nobody shows up is ridiculous. We had very sloppy auctions in August, September, October of 2023, and the bond yield did go up to 5%. There's always going to be some yield at which there's going to be plenty of buyers to clear the market. What happened back in 2023, of course, is Janet Yellen, who's at the time was Treasury Secretary, on November 1st, essentially told the bond vigilantes, if you don't like my bonds, if you don't like my notes, I won't issue any more than I have been. I won't increase the issuance. And to the extent that I have to raise more money, I'll do it in the bill market. So in effect, that was yield curve control being played by the Treasury. In a extreme case, it's conceivable that the Treasury could always tell the bond market, we're not going to issue any new bonds, any new notes. We're going to do it all in the bill market. And that would force the Fed to buy all those bills at whatever interest rates the Fed deems would be consistent with its mandate of keeping unemployment down and inflation down. And of course, that could have a very bullish impact on the bond market. So again, the bond vigilantes are not in full control of the situation. The Treasury can, play this game of chess with them. The Fed, if this all did lead to a kind of a Ray Dalio debt crisis, where, oh my God, for a day or two, it looked like all hell was breaking out in the Treasury market. The Fed could view that as a financial crisis, financial panic that would require them to intervene with quantitative easing and arguing that under the circumstances, they feel it's appropriate to be buying more bonds and notes. So, this is all very interesting times here. We're kind of pushing the outer limits of things. Well, we've been doing that for a while. I mean, what was QE? What was QT? Those were extraordinary measures that turned out to be not as transitory as the Fed build. They were with us for quite some time. And now a lot of possible scenarios could play out in the credit markets. Look, in some ways, in my heart of hearts, I wouldn't mind a debt crisis here for a week or two to get the attention of the politicians to recognize that first and foremost, they've got to come up with a credible budget plan that kind of live up to what Scott Bessent promised that the Trump 2.0 administration, with him in the Treasury, would deliver. And he said, over time, we should be able to deliver a federal deficit that is equivalent, that divided by nominal GDP is 3%, down from about 6 to 7% right now. There's nowhere in the Constitution or the Bible says that that's the magic level that we can all live with and everything is just hunky-dory. But it sure beats 6 to 7% deficits of nominal GDP. And if objective scores of the whatever the Republicans come up with, and maybe the bond market conclude that, hey, they've really come up with something that really is meaningfully likely, credibly going to get the deficit down relative to nominal GDP, that's a good thing, and that's to be welcomed. And there's no reason for the bond yield to rise from here. If instead they come up with something that gets scored atrociously, and the bond market decides that that's the case, that they haven't really done anything to deal with the long-term deficit problem, then you could have an immediate negative reaction in the bond market. It kind of reminds me of TARP. Remember when Congress passed TARP in reaction to the financial crisis in 2008? The initial reaction of the stock market was to gag and to say this is not going to work. It's not going to do what we need to do. And then 1 week later, Congress came up with another version of TARP, and that seemed to be much more serious in dealing with the problem. So it's conceivable that over the next few weeks, next few months, the Republicans will finally get their act together, come up with a big, beautiful bill, and the bond market will decide that this is really a very big, ugly bill, and that we would have a mini Dalio debt crisis. Dalio makes it sound like it's kind of going to be the end of the world, but I think the deficit was created by humans, and it could be tamed by humans. All we have to do is slow the growth rate of outlays and increase the growth rate of receipts. That's the arithmetic issue here, and it's simple enough. But politically, it's a whole nother ball of wax. Now, again, it's conceivable that the Bond Vigilantes, recognizing that the Treasury can always counter any move that they put on to get Washington's attention by playing yield curve control out of the Treasury Department instead out of the Fed. It's possible that bond market's going to continue to stay right around here at 4.5%. That's been our forecast for this year, 4.5% plus minus 25 basis points. We still think that's the most likely scenario. We're not expecting any kind of a calamitous debt crisis issue here. Though, again, we're not dismissing that possibility. And if that's the case, maybe the stock market's going to figure, well, if the bond market doesn't really care about this, we certainly don't care about it. And we continue to have this melt up in the stock market. The only problem we have with the melt up in the stock market is we're almost back to where we were before this correction. And even back then, it was pretty clear that valuation multiples were rather stretched. And it's hard to imagine that we're going to have kind of a potential for another melt up, melt down scenario in the stock market. We were talking about that possibility as one of the scenarios, kind of a 1990s style melt up, melt down. But I think I fairly consistently said that doesn't have to mean it's going to be identical. It doesn't have to be a meltdown that turns out to be a bear market. It could be a correction, as we just saw. Maybe we're set up for another one of these corrections following a melt-up scenario. But we clearly have seen valuation multiples going up here. So with that, let's go look at some charts here. I got them ready to go. By the way, I've I've been in touch with Eric. Haven't given him any advice, but Eric started out with the Council of Economic Advisors on May 1st. So basically, he worked for me for a year. I taught him everything I know. So let's see if he takes that knowledge and puts it to good use with the new administration. He does have a pretty impressive title already. I think his title is Senior Advisor to the Chair of the Council of Economic Advisors. So in theory, he's only at 1 degree of separation away from the president. It's the only person between him and Donald Trump is Murren, who's the chair, which I would like to have the hallucination that therefore I'm only 2 degrees away from the president. Maybe I'll whisper something to Eric. I'm sure he'll maintain a posture of not responding to any suggestion I have, but maybe I can influence him, and then he could influence Murren, who can influence the president. Anyways, we don't need to do all that. Looks like the bond market and the stock market are doing an awfully good job of getting the president's attention. And as we saw, the bond market on April 8th seems to have convinced the president, and certainly Scott Bessent, that they had to postpone the reciprocal tariffs. Well, without any further ado, let's look at the 10-year U.S. Treasury bond yield. Little history going back to 2023, where this is what happened is, if you remember back in 2023, this was roughly from August to October, we went from roughly 4% to about 5% in a heartbeat here. Along the way, I think it was on November 1st that Bill Ackman covered his short very publicly. So it was a great trade because he shorted the bonds at 4%. Again, a great trade. And Janet Yellen basically came up with her more bills policy, as I call it. And the inflation news came out lower than expected. So we had a nice decline in the bond yield. And then you started to see the bond yield moving higher. And this was the Fed decided to cut the Fed funds rate by 50 basis points. And we argued that that was not necessary and that it might lead to higher bond yields, and turned out to be a pretty good call because the bond yield did in fact go up substantially. Then we had again a nice little decline in the yields. This is Liberation Day when the bond market figured this could cause a recession, and then we went from 4% to 4.5%, basically in 24 to 36 hours in reaction to Liberation Day and all the commotion it created with the basis trade. This freaked out Bessent. Bessent went to Trump and convinced him it's time to postpone Liberation Day. So they did that on April 9th, only a few days, 7 days, 1 week later after Liberation Day. And then we kind of fluctuated around here. We got China tariffs postponed, and now we have to add Moody's downgrades the U.S. debt. So that looks like it's going to push things up a little bit. But again, our working hypothesis is 4.5% is a reasonably comfortable rate for the economy. It's where we were before the great financial crisis. And there's no particular reason why the bond market couldn't stabilize around this level. Um, and again, the notion that the bond market's going to freak out about supply, it's known about supply. It's known that the politicians aren't doing anything about it. You know, when I coined the phrase bond vigilantes way back in July of 1983, I went back and read the what I wrote. I have it on my bookshelves. And I wrote that the bond vigilantes are particularly concerned about the record $200 billion deficits that the government was running. Now we're talking about $2 trillion deficits, and yet we're still at levels of the bond yield, which the economy can deal with. This is what the Fed did last year, September 18th. It lowered by 50 basis points, then another 25, and then on December 18th, another 25. So by 100 basis points. And we fought that, well, not fought it, we questioned why that was necessary. And so did the bond market. You see the bond yield actually rose quite sharply. Now we started out the year at around 4.8%, have come down, and now we're fluctuating right around the Fed funds rate level. Again, we're in the none and done camp, thinking that the Fed's not going to be lowering interest rates and that the bond yield should stay around here. So here's a chart of what the Fed funds futures market thinks is going to happen in the next 6 to 12 months. And for the past period here where everything is red, meaning that they're expecting rates to be cut by the Fed, they've been expecting too many rate cuts and have been having to cut that back. In our current situation, they're expecting over the next 6 months, one rate cut of 25 basis points, and then roughly 3 rate cuts of 25 basis points each over the next 12 months. And we're thinking none and done through the end of the year. Then let's revisit it again. Meanwhile, the poly market, which is available daily, is tracking inflation, recession expectations now is down to 37%. So that's been cut substantially ever since Trump backed off or postponed his tariff, at least his reciprocal tariff war. And so that's come down. And the economy continues to demonstrate its resilience with initial claims, for example, remaining extremely low, labor market remaining quite strong. And I know retail sales were weak, up only 0.1%, but that was April, and that was after they revised up from 1.4% to 1.7% in the month before. And Atlanta Fed actually marked up its reading for real consumption spending. We'll look at that in a minute. Here's the stock market also with our little nifty reminders of where things were. All-time record high, February 19th. Here's the election, all-time record high. Then the market starts to fade as Trump talks more and more about big, beautiful tariffs. We all come to realize that he's not kidding. He actually means it. And then here's Liberation Day. And there was a lot of questions whether that would mark the bottom in the correction. Well, it didn't. We didn't think it would. So we took a dive down through April 8th. And then we had the tariffs postponed, nice little rally. Couldn't go all the way back to the lows, which is a good sign. And then we've continued to rally since then. So on May 12th, Trump postponed the tariffs on China. So we're not all the way back to where we were, but we're getting close. Meanwhile, the bond market, from a fundamental perspective, tends to be fairly highly correlated with the Citigroup Economic Surprise Index, and you can see that correlation is pretty tight with the U.S. Treasury, the 10-year Treasury. If you take the 13-week change, it's a pretty good correlation. And so maybe the treasuries haven't done much so far this year because the CESI, it's been a little bit negative, but it really hasn't done much either. So the economic fundamentals kind of leave us in limbo here about what's really going on. You can argue it both ways. We're in the resilient camp, and the bond market is isn't voting one way or the other. Meanwhile, the auctions, the 10-year auctions continue to go off pretty well. So there's no sign that we're having some issues there. This was the 2023 experience, so we had some sloppy auctions back then, but they did get sold. They just got sold at a higher yield, as we saw. Meanwhile, the stock market has had one heck of a V-shaped recovery, and it's all been because of valuation. The forward PE of the S&P 500 has actually stalled out at a record high in recent weeks, just as the market rebounded dramatically. So it's all been valuation, and you can see that the forward PE of the S&P 500 is back to 21. That's the blue line. And I think it got down to about 18 if you look at over here. So, we're back up here. So we're not that far off from the high at the beginning of the year. We're not at 25. We're not at these levels. But I think we would all argue, it's not an argument, by historical standards, valuations are pretty high. If you look at the price to sales ratio, at the so-called Buffett ratio, we can do that on a weekly basis as well. And that's back up to 2.9. And Buffett, way back when, said he gets nervous when that ratio is above 2. This is another slice and dice of the forward PE. This shows you the S&P 500 forward PE at 20.4. This is weekly data, so it's got a little bit of a lag to it. I think the other one was daily, if I'm not mistaken. No, that's weekly too. But anyways, the S&P 500 X Magnificent 7 is not too bad, 18.5. The Magnificent 7 have had a heck of a recovery in their forward PE. So I guess much will depend on what the economy does from here. I think the economy looks pretty good. You wouldn't agree with me if you're a big fan of the Consumer Sentiment Index, but I'm not a big fan of the Consumer Sentiment Index, as I've pointed out to you many times before. Any data that doesn't support my story is really bad data, and any data that doesn't support my story might be revised to show I was right after all. But this just isn't working here. I mean, clearly there's a partisan issue here. Democrats are much more depressed than Republicans. Younger people with student loans are much more depressed than older people. But one of the strengths of the economy here is the older people. The baby boomers are spending. A lot of them are retiring, and the spending goes on. You can go to the morning briefing just to look at our discussion of the Consumer Sentiment Index versus the Consumer Confidence Index, and our averaging of the two of them over there. So you can look at that if you haven't already. There's something odd about the inflationary expectations that are being reported in these surveys. This is the Consumer Sentiment Survey, and you can see that inflation expectations are jumping like crazy. You wouldn't know that looking at the inflation spread between the 10-year Treasury and the TIPS yield. So that's a kind of a dislocation. There's even a dislocation between the 1 year ahead in the Consumer Sentiment Survey up here and the FRB New York Consumer Survey. It's a little old. It's April. This is May, but you can see that this even back here was much higher. So again, I kind of question the Consumer Sentiment Index as being very useful. And look at this, the Consumer Sentiment Survey inflation expectations used to correlate very closely, track very closely at the price of gasoline. And here it's completely, I guess everybody's just reading these articles that tariffs are here, they're coming. It's going to lead to much higher prices, and that's fueled this kind of inflationary shock. Certainly is one reason the Fed should be in no reason to lower interest rates. Retail sales, they weren't very strong, up only 0.1, and that's in nominal terms. People are still going out to eat. Maybe that's the baby boomers doing so. But all in all, you have to put this in conjunction with the March data, which was not only strong, but was revised stronger. And I don't think this is the beginning of a weaker consumer. As a matter of fact, the Atlanta Fed, as I mentioned, is now tracking personal consumption expenditures in real terms at a rate of 3.7% at an annual rate during the second quarter. A week or so ago, it was tracking at 3.3%. So their numbers are getting stronger for what's going on in the second quarter. This is just some retail sales trends is still solidly to the upside. People are going out to eat, all-time record high. What else? Yeah, there's bad news here with the consumer delinquencies. Consumer credit delinquencies are up. The student loans, now that they're have been reestablished, we're getting delinquencies there. So lower income consumers certainly are under stress. Well, I hope you're not under too much stress. Let me just take a couple of questions. I always overstay my welcome, but I'm glad to see that many of you hang around. So let's see who we've got here. Rajneesh, the 30-year yield touched 5% today. The 10-year yield is also headed up. Wouldn't this impact the stock market performance adversely? What's your view on this? Secondly, with deficits showing no signs of being contained, could there be a scenario that investors seek a much higher premium, thereby keeping long-dated treasuries elevated? Rajneesh sent that in at 11:04, and that was the topic of my entire presentation. So Rajneesh, I hope I covered all aspects of your question. But thanks for your question. Lee, while earnings have remained consistently high, most analysts and corporate leaders are prognosticating lower earnings due to tariffs and tariff retaliation. Are they correct, or simply being conservative in their future earnings calls? Denigration of earnings would certainly harm the equity market. Yeah, I've been pointing out that when we do PE times E, we use forward PE times forward E. And forward E, which is a time-weighted average of analyst expectations for this year and next year, forward E has been moving sideways for the past several weeks at a record high level. So it stopped going up, and that's because the estimates for this year and next year are coming down, but next year's estimate is still around $300 per share. This year is about $265 per share. I update these every week, almost every week in the quick takes. And so the estimate for this year and next year are going down, but because it's a time-weighted average, we're converging towards next year's estimate. Yeah, I have a concern about earnings. As Trump has just demonstrated, tariffs are not something that automatically gets paid by them, by foreigners. Tariffs automatically gets paid as a check by Walmart to the Treasury, and then it's up to Walmart to see how much of that they can pass on to consumers, and or how much of that they can get discounted by foreigners. And also the dollar has an impact on all this. But for now, it's pretty clear that there certainly could be, there's not going to be a positive effect on the profit margin, and it's probably going to be a negative one. And so far, the stock market seems to be kind of ignoring that because the valuation multiple suggests that the market's actually looking past all that, thinking that the tariff issue will be behind us, not just politically, but also in terms of its impact on the profit margin. I think the stock market's looking at this is what it's supposed to do. It's looking out over the next 12 months and beyond. And so it may already be looking into 2026 and figuring that, once we get through all this bad stuff, there'll be a lot of good stuff that will sustain the market. But again, we are raising the question of a possibility that the bond market could act up here, which then could make it harder for the stock market to continue to enjoy this melt-up scenario. I think that's it. Let's see. One more, if you don't mind. Lucas, any thoughts on gold here? It's been a 10% correction from the tariff tantrum highs, but maybe the US dollar is not dead. And even if the US dollar does not go up, gold could just stall. Yeah, I mean, we've been bullish on gold, still using 4,000 as a target by the end of the year, 5,000 by the end of next year. There's no, uh, great model behind all that. Just an extrapolation of the trend, the channel trend that we've seen in the gold market. It did get to the upper end of the channel a couple of weeks ago. It went above it. Now it's kind of back below it. Seems to be stalling out here with a 10% correction. What we think is driving gold is central bank purchases. We don't think that's going to suddenly go away. But to the extent that you know. Indians and Chinese and others have been buying gold as individuals or institutions because of issues with tariffs and the like. Maybe that's some of that is risk. If we're not going to have as much risk on the geopolitical side, then gold takes a little breather. But I think the trend is still to the upside. And we've been pointing out that the USD dollar index is a very misleading index of the dollar. It's not a trader weighted index. It's got fixed weights, and 57% of it is the euro. So don't think about it. You think about it as just the euro for all practical purposes. So, what's the point of all that? Anyways, I hope that you all have enjoyed this recovery, and it's been a relief rally. I think we're all relieved. But maybe the easy V-shaped pattern is now going to be a little bit more challenging. We'll do what we can to help you. If you can do everything you can do to help us, send us. You're always sending us good insights as well as links to articles and opinions of others that you want us to respond to. Appreciate all that. And we'll see you next week. Have a good week. Thank you.